Welcome to this discussion on taking stock of regulatory reform. I'm very pleased to be moderating this discussion actually because from a professional perspective this is a topic that's extremely close to my heart. I run the capital impact studies work for the IAF, which we just submitted our latest report to the Basel Committee just last week, and I'm particularly pleased to be discussing it with such a distinguished panel. Obviously, over the last 11 years since the crisis, and I've learnt as an Australian not to use the acronym GFC because I think it's an Australian-only thing, but since the crisis, we've witnessed a profound transformation of the global financial regulatory agenda for the global financial sector. A lot of people have used the term a tsunami of regulation to describe how much has been done over that 11-year period. The topic we've got today has two elements: assessing the impact of regulation, taking stock of what it is and what the impact is, but also looking at unintended consequences, which is a central theme of the study work we do from the industry perspective. With respect to discussing the impact, I don't want to just look at what the impact is in terms of balance sheet terms or capital changes. What I want to look at really is what does the regulatory change, the reforms mean? What do they mean for the provision of financial services? What do they mean for business investment and development? What do they mean in terms of strategic considerations for the sector? I think that's a more interesting topic for us today. And then I'd like to extend those kind of considerations into the assessment of the agenda in terms of consequences for growth. What does it mean economically? What are the implications? We've heard a lot of speakers talk about this in the last 3 days, but also look at unintended consequences where things that weren't expected when the reforms were developed have emerged or are emerging as people start to consider them for their own businesses and jurisdictions. And with regard to unintended consequences, how are they identified and how we deal with them? The other thing as a theme I'd like to think about is timeliness. I think that's very important because we're at a critical juncture in the whole regulatory reform agenda in terms of global circumstances. We're moving from global, the reforms are largely complete on a global space to local. And that global to local throws up a whole lot of its own issues and challenges. And I think, therefore, it's an ideal time to be having this discussion. So let's kick off the discussion with this great panel. John, I'd like to put the first question to you. You're the chairman of a large multinational bank, diverse range of businesses and industries. You've been working in the sector for many years on both the regulatory side, as a very senior basis as the OCC, and also advising a large range of companies in the sector. How do you consider the changed regulatory environment influences the way Citibank approaches major decisions in terms of things like structure or investment decisions, the international investment or withdrawal, both important? And how do you think that process may have changed over time, since before the crisis, but even in recent times?
So in order to answer that question, I sort of think the predicate is to talk about what are the really big regulatory changes that affect the biggest financial firms, including but not limited to Citigroup. And so I think the really consequential ones are: 1, much higher equity capital; 2, much higher liquidity requirements, much higher requirements for highly liquid assets on the balance sheet; 3, stress testing, the CCAR stress testing in particular; 4, resolution planning, and the whole set of requirements that are around that; and 5, this is less sort of mandated in statute, but it's real, is kind of restrictions on the risk appetite that firms have. So when I look at those 5 things together and what Citi has done since the financial crisis, there are many obvious things and some that are not so obvious. First, I think the company made a very deliberate decision to slim down and to get rid of a number of businesses that were not core to its business model, which were in the new environment not sufficiently profitable either. And so sold off about $700 billion worth of assets, which is a huge bank in its own right over a period of time, to kind of focus more on its core strengths. So that definitely changed how Citi views what it should be doing and sort of concentrating on those. And then I think you have to say the higher capital requirements have really steered people away from very capital-intensive businesses that don't produce really strong returns, and it's just changed the nature of the business. So there's much more of a focus on what we call the accrual businesses that have produced steady returns, don't use as much balance sheet to balance off against our very robust trading businesses that we have. And so I think that's really an important point. But there are places where there are kind of what I would describe as unintended dislocations. And one I'll give in the United States is the Basel III agreement made it very punitive in the United States, given the United States model for the mortgage business, to engage in the activity of mortgage servicing. Mortgage servicing rights are very punitively treated as a matter of capital under the Basel III. Now, this doesn't affect as much non-U.S. firms because their businesses, the mortgage businesses in other countries, are less dependent on selling mortgages to third parties and then continuing to service the business. But it has meant in the United States that other than the very biggest providers of JP Morgan and Bank of America and Wells Fargo, a lot of people have been exiting the businesses. And I'm not sure that was an intended thing, and I'm not sure it's a good thing overall as time passes. And then I would say on the risk appetite thing, we at Citi, for example, have shied away from being an industry leader in things like leverage lending, where the risks we perceive as being higher. Not that we think that's a bad business, we're still in it, but it causes our business model to change in a very significant way. So those are some of the examples that I could give, but it's definitely a different business model and a different business than it was pre-crisis and pre these new requirements.
That's excellent, and it brings into focus those broad strategic investment decisions and how they're flowing through, and the competition elements I think are pretty important. Frederick, if I can go to you now, keeping with the industry view, you lead a very large international banking business that has elements across the whole sector. On a more granular level, what do you consider to be the main impacts of your business regarding specific strategy considerations, portfolio composition, business mix for Societe Generale, and how do you see the future direction of your business being influenced by the profound agenda that's now in place?
Yeah, good morning to all. I must say I would largely echo what John has just said in terms of trying to concentrate on what we could call core businesses. We also exited in the last few years many businesses which were too small. I would add, of course, also the changes which took place in, for example, the capital markets compared with 10 years ago with all the different regulations which took place. So on our side, it's fair to say, what I just would like perhaps to add is beyond all the prudential regulations that John has just added, these changes, first of all, take place also at a time where we see the emergence of new technologies, which means to rethink about how we do business. Secondly, for Europe now, potentially this environment of low rates for long, which will further change a lot. And probably also these issues around climate changes, which will mean also a different way of thinking about capital allocation. So first of all, a lot has been done, but there's still, I think, a lot which will happen going forward. And just to take our examples, we also decided to exit certain businesses which were nice to have, I would say. But as we've said, because of the burden of these businesses as being part of a large group, a global CFI group, with all the supervisory requirements in terms of information capacity to be provided at the central level, we felt we might not be going forward the best shareholders. And for example, we exited all the small activities we had in the Balkan countries, as well as, for example, a nice but small private bank we had in Belgium, because again, the scale was not there going forward in terms of investing and meeting all these requirements. I think that going forward, it will further take place. You need to concentrate on your core expertise. Clearly, I would add also allocate more capital where there is more profitability. From that perspective, I'm a little bit worried because what is happening in the Eurozone will mean, I think, put more capital outside the Eurozone. Second, of course, pursue the originate to distribute model. Basel III will mean a lot of that. Basel IV, sorry. And we'll meet. I don't know. I hope we're not entering into 5. But you see further originate to distribute with, I must say, a good opportunity, because when you think that precisely with a lot of assets with low yield, there will be appetite from investors for precisely infrastructure finance assets, energy, renewable assets, etc. So the environment, to a certain extent, could help to further accelerate the originate to distribute model. And then, just as a final comment, I think we will see more, because also if we enter really in a slowdown of the economies, we will see also the impact of accounting, for example, IFRS 9, all elements which are also related to the provisioning of NPL. So I must say, we will see more banks trying, as John said, to develop less capital-intensive activities. And I think it will be very important to see what is happening in the next 2 to 3 years, because it could mean less capital available for credit.
Yep. Very good. Thank you, Frederick. We've heard from 2 very large financial institutions some of the strategic implications already, and we don't even have the local promulgation. We're still considering the global picture. Doug, you've worked across the sector for many, many years. You deal with a lot of financial institutions. From a strategic perspective, how are you seeing the financial sector and different institutions approaching their response, I guess, to the new regulatory environment? And are you witnessing a contrast in responses in terms of examining it in strategic decisions?
Well, thank you. It's a nice group of questions there. I think it's important to look at what time frame you're talking about. So I'll both look at the grand sweep of it and more recently, and geographically, because there's clearly been a massive impact of the regulatory changes in Europe and the US over the last 10 years. Less so in the rest of the world. Mm-hmm. Parts that didn't have the financial crisis to the same extent, or that have quite different business structures, like in Asia, have tended not to react nearly as much. But US and Europe, big impacts. As both of my preceding panelists have talked about, massive changes in the financial structure of the institutions, which, since money is the raw material of finance, is highly significant. Changes in risk management, generally very positive changes, and all the consequent changes in business lines. Both of them talked through those, so I won't go in a great deal of detail. So that's kind of the grand sweep. There definitely has been massive impact. More recently, though, there's a real contrast. In the US, the great bulk of the regulatory change is over. And in fact, we've even seen the pendulum swing metaphor that people use. The pendulum has swung mildly back on the regulatory front, away from what was probably a somewhat extreme of changes. In supervision, not so much yet. I think we're all kind of waiting to see if the pendulum does swing there, but the bankers I work with feel like they haven't seen much change in supervision. So instead, the focus in the US is much more on digitalization, cybersecurity, the search for revenue growth, the things you're thinking about in a broadly healthy sector. Europe is just a different story. First of all, on the pure regulatory front, capital requirements continue to be pushed up there, even as we speak, with stress tests kind of get ratcheted up each year. The TRIM process in Europe has pushed up the average risk weights for the same assets, and there are other things like that. There's regulatory pressure to deal with the NPL problem, which, as you deal with that, you end up using capital in order to be able to get rid of the NPLs. And as was mentioned, Basel IV is coming up. I suspect that Europe will modify it to some extent, but if you directly take it as Basel has presented it, it's a pretty big hit to capital in Europe. And this is an environment in which it's really tough to be a bank in Europe in the first place. Negative interest rates are very difficult for any banking business, any finance business pretty much. They still have high cost structures, which to their credit they're trying to work on, but there are actually a lot of barriers to restructuring within Europe, some cultural, but many of them legal and political, that make it difficult to bring it down. One thing I found interesting, I met with Luis de Guindos earlier in this week, who's the vice president of the European Central Bank, and he's in charge of financial stability. As he said publicly and also said to me privately, one of his 3 biggest concerns about financial stability in Europe is how do you have real stability in a banking sector that doesn't make very much money? And when you combine that with these regulatory impacts that are creating higher capital requirements, so your ROE goes down as a result of that as well, it's a tough situation. Now, taking the third time frame, which is to look forward, I will say one positive thing. I had the opportunity to speak at the ECOFIN in Helsinki a month or so ago, which is basically a gathering of the finance ministers and central bank governors of the European Union. And I was asked to speak about rebooting capital markets union, because there is a recognition, as there has been for some years, that integrating capital markets across Europe is very important to the health of the financial sector and the ability of the economy to grow. There's been disappointment with the progress made over the last 5 years on that, and so they were looking for ideas as to how to push it forward. The reason I put this in the optimistic camp is, while it's easy to be skeptical about this, and I'm sure that most of this won't get done, at least anytime soon, I do think there will be positive step forward, including, as Frederick was talking about, I think there will be moves to make securitization easier. There have been some attempts by the Commission already, which have essentially failed, but I think there's a recognition of that and a clear desire to find ways to truly make it work better. And then the other forward-looking thing I'll just mention, and I've written about this if people are interested in seeing more, I've become convinced that the changes in the regulation of the financial sector have actually made it more pro-cyclical as regards the economy. So that if we run into a small or medium-sized recession, I think the banking sector will aggravate it more than it traditionally has. The only good news there is I think that we have actually made it so that if we had a major financial crisis or a major recession, that there would be less pro-cyclicality because we have an essentially significantly safer system.
Okay.
So I'll leave it at that.
Thanks, Doug. I think some of the things you said and that each of John and Frederick has said is a good segue into the next question I'd like to ask to Felix. But so that the regulators don't feel under siege here, I don't know if people at the lunch yesterday, but Jamie Dimon said that the regulators should do a lap of honour. The Lehman Brothers wouldn't happen today, he said, because of what's been achieved in terms of stability and soundness. But he said, however, and there's always a however with Jamie, a number of regulations are constraining markets and therefore growth. So, Felix, it's been interesting. We've heard from the industry that investment is being wound back in a lot of areas. We're seeing reduced competition, considerations or implications. How do the regulators strike that or seek to strike that balance between stability, which is obviously accepted as your core mandate, and the element of growth? What sort of consideration do you give to growth implications in your processes?
Yes, thanks. And thanks for having me. It's a pleasure to be back at the IMF meeting and the IF annual meeting. It's great to be here. Great crowd. To your question, well, getting the calibration right between regulation, which by definition is constraining, and let me call it entrepreneurial freedom, growth, or what have you, on the business side of things, is sort of the name of the game of regulation forever. That's I think, well understood. But let me make sort of a more bolder statement as a regulator. Growth as such is not a direct parameter of financial regulation at all. The loyalty of financial regulation belongs to risk. And risk, both on an individual level, we call solvency, as well as on a systemic level, we call financial stability. Of course, we are absolutely aware of the fact that all the tough policy choices you have to make if you calibrate risk well, how much risk appetite from a societal point of view are you willing to accept, and how intrusive, consequently, does regulation has to get in a given point in time, does impact the ability to grow, the ability to entertain certain businesses. That is absolutely well understood. Why am I making that point, that conceptually growth is not a direct parameter of financial regulation, and it shouldn't be? Because in many more times than not, there are attempts from the political world to use, or one might say misuse, financial regulation to promote all sorts of political purposes unrelated to risk. Take SMEs. I mean, who is against supporting SMEs? But if you scale down risk for SMEs, ignoring risk, you're in trouble. Take green supporting factor. You know, of course we know we have to invent all sorts of things, and financial services industry is part of that. But a green supporting factor, ignoring financial risk, is implanting the seed for the next financial crisis. And that's why I'm, as a regulator, and I have to do that, at the very core of my mission, to make the point that anything unrelated to risk is an unacceptable parameter in the world of financial regulation. And I repeat myself, that doesn't mean that we are not extremely well aware of the consequences of what we do as regards sort of economic consequences. Which leads me to another point, which of course, that's why proportionality is such an important thing. I mean, we shouldn't treat medium-sized banks and smaller banks the way we treat large banks, neither from a regulatory nor from a supervisory point of view. That is a particularly important statement in Europe, because Europe follows the approach of a single rule book philosophy, unlike the US, for instance, or Asia, for that matter. So within a single rule book approach, framing proportionality is quite a challenge to get that right and not falling into the trap of sort of overburdening smaller companies. That is extremely well understood, so I'm a big supporter of being more explicit on proportionality. The third point I'd like to make is very fundamentally, and I think Doug made the same point already, is I'm quite worried about the swings of regulatory cycles, not to say fashions, which of course are happening. You know, we had a massive wave of deregulation prior to the financial crisis. We had one of the biggest financial crises ever. We had 10 years of massive re-regulation. Now we are probably somewhere around the peak of that. And I'm of course afraid that we are now pushed into a new downward cycle of deregulation. Let's not do that. I mean, a little bit of breathing is necessary, and that's fine, but the volatility of those swings just have to be reduced. There has to be more continuity. It's detrimental to everybody, both the industry as well as the public good in a way, to do that. Let me add a fourth point to the pain John and Frederick already mentioned from an industry point of view, which makes things even worse. You have mentioned examples which are coming from a traditional prudential regulatory toolbox: capital, liquidity, risk management, and potential consequences. That's well understood. I mean, there is a second strand of regulation which has been emerging over the past 10, 15 years, pretty much driven by security regulation, but now spilling over dramatically into the banking regulation and, in fact, insurance regulation as well, which is conduct regulation. Mm-hmm. Conduct regulation is a quite different animal. It's originated differently. Prudential regulation is pretty much an expertise-driven thing. A bunch of rocket engineers meet in some back rooms and negotiate for a number of years and come back with something nobody understands. Conduct regulation is usually driven by huge mis-selling scandals, creating massive political hype cycles and the need to react politically very quickly. So the danger of of over-tuning the political answers given to something like that is very high, very high. And unsurprisingly, we have seen that. And that's a field where philosophically, of course, being a good regulator, I do appreciate the need for well-crafted conduct regulation. So nobody should get me wrong on that. But the danger of overshooting is much higher. And in fact, if you talk to the practitioners, and we do have practitioners here on the panel, from a red tape, bureaucratic burdening point of view, in many, many cases, conduct regulation is as intrusive as prudential regulation has ever been. So let me stop here, because I would hope we would possibly come back sometimes later throughout the panel to some of the new emerging things like AML, or crypto, or cyber risk, or something, which of course poses a very new set of regulatory challenges.
If we'll be here all week, I think, or we have been here all week talking about exactly those things. I should remind people that through the app, if you want to send a question through, please feel free to do it. Or give me an update on the Brexit debate. Please don't send that through. Just before I ask my next question, and of you, Benjamin, I saw that there was a little bit of banter between Frederick and Felix about Basel IV, as Frederick, as industry likes to call it, and Felix reminded me it was Basel III. I think what we should do is, I thought we should call it Basel pi, you know, the number pi, because it's between 3 and 4. So it's perfectly placed. It's a universally accepted number. But then I thought, no, it's probably not a good idea because pi never ends. So let's not call it Basel pi. Benjamin, if I can ask you've and the Bundesbank does a lot of work, and your group in relation to the impact evaluation work that's taking place under the new structure that's been set up at the Financial Stability Board. There's been work done on infrastructure financing, SMEs that have been referred to already, and of course the very important too big to fail process is getting underway. If you, in the next few minutes, you just give us an insight into that impact evaluation process and how it's evolving, and maybe some concrete outcomes that we can expect.
Thank you very much for inviting me and having me here. I will try to give you some background on why we are actually doing this endeavor of evaluating reforms, what we've learned so far, and some of the results point to a different direction compared to what we've heard from individual experience, and what we can expect from the ongoing evaluation on too big to fail. I mean, first of all, the G20 reform agenda aimed at making the financial sector more resilient, and by doing so, it also provides the basis for managing the risks that may emanate from the deep structural change, also alluded to by colleagues, that we witness now in the financial sector. So the most important question for evaluating the G20 reforms is not so much the unintended consequences in the first place. It is have the reforms achieved their intended objective? That's the first question to be answered. So, for instance, we want to know if implicit subsidies have actually been reduced in the system, and of course we want to know if the financial system is indeed more resilient compared to pre-crisis times, and of course this is also part of the evaluation, but it's a part of the work we are doing. Are there potential unintended consequences? And these can be positive and negative, not just negative. So ultimately, the policy evaluation is a main ingredient of a policy cycle that every policy area has, and it is key for our accountability towards those that are addressed by regulation. So the financial sector, but also the wider public, those who benefit from regulation. Under the German G20 presidency, the FSB introduced some structured framework to evaluate financial sector reforms. And this is quite new because it requires us to follow a structured assessment process. So it gives us guidance for conducting ex post evaluations, and it is also designed to facilitate a shared understanding of what constitutes good evaluation and good evidence. This is it's just a reminder that the plural of anecdotes is not evidence. So we need more than just anecdotes. And the framework is needed to enable an analytical assessment of reform effects, and in the global community also to coordinate the evaluation of reforms with cross-border effects. And many of these reforms that were initiated by the G20 have cross-border implications. As you mentioned, 3 projects have already been conducted and almost completed under the framework. 2 projects were mostly focusing on unintended consequences, so not so much on the objective of reforms. This was the financing of SME and also the financing of infrastructure projects, because these were first-order concerns of policymakers, whether or not reforms affected those financing needs. And the other one was a project on incentives for central clearing of OTC derivatives. And this was the first project that aimed at analyzing if intended objectives were actually achieved. So the result of those 3 projects was that there was no major unintended consequence to be observed. In case of the OTC derivatives project, there was something handed over to the Basel Committee with respect to the interplay between the leverage ratio and initial margins for client clearing. So here you see the interaction also of the evaluation process and the regulatory bodies that will take up some of the things that are identified as potentially problematic later on. So what are and the latest project? It's a too big to fail project, which is a very comprehensive project, which aims at the too big to fail reforms. One of the major elements of the reform of the G20, and this project will deliver its first public consultation report in June 2020, next year. So you should mark this in your calendar if you're interested in that topic. And the final report will be published at the end of 2020. So what are the main lessons so far from the FSB evaluation work? First, transparency is crucial for the credibility of the whole process. So to this end, the FSB entered into an extensive dialogue with stakeholders through public consultations and workshops, and many industry participants were able to provide input to the whole process, as well as academics. In the case of the too big to fail evaluation project, there is also an academic advisory group now established with distinguished experts that support the whole process to make this much more meaningful and comprehensive. So what are the concrete outcomes we can expect from too big to fail? In terms of the mandate, the group itself is not meant to issue policy recommendations. It's a purely analytical group. The mandate is analytical, which means they publish a report, compile evidence, and this will be the basis, hopefully a sound basis for discussions later on for the FSB and also for the wider public. In terms of contents, the project seeks to address three questions. It's first to what extent we've seen a reduction in systemic risk and moral hazard. This includes implicit funding subsidies and also the progress in resolvability of too big to fail institutions. A change in whether we see a change in business models and risk profiles, also something that was alluded to already, and broader effects, which is the more difficult part. To what extent the structure of the economy was impacted by the reform, also the functioning of financial markets, global financial integration, and the cost and availability of financing.
Thanks, Benjamin. I'm mindful we've got about 10 minutes left, and I had a number of other questions to ask, but very quickly a response in terms of whether has the regulatory sector got the balance right on the pendulum between stability and growth in response to that, and also are they getting it right on reviewing unintended consequences, or is that a wait and see? John and Frederick, perhaps, and Doug, if you've
very quickly, I do think there is a trade-off ultimately between regulation and growth. I think fundamentally the increases in capital and liquidity have been very needed and warranted, but you can go too far and the returns can become quite diminished. I've been heartened by recent statements by the Federal Reserve that in the United States, we've already gold-plated a bunch of the regulations to make them more than the international standards, and to keep going in that direction, to continue to raise capital or liquidity requirements or other requirements without being mindful of both the competitive effects and the growth effects, I think would be a mistake. And so I'm glad to hear that there's a notion of, in the aggregate, we've got capital about right, and as we look at new and additional ones, we've got to take that into account, that if we add somewhere, we ought to figure out how to reduce in another place, and so I think that's important. And I guess the last point I'd just make about this, I look at this as the trade-off. You know, if you wanted to have a traffic system that had no accidents, you'd make everybody drive around in tanks and go 3 miles an hour, and you would definitely lower the amount of accidents and deaths in the economy. But there's a notion that you can't work that way. There is a certain amount of risk that you have to, that banks are in the risk-taking business, and I think we do have to be mindful at a point of the trade-off. So,
Frederick, I don't know if you had any thoughts or.
Again, I would definitely agree. I think that effectively Europe is in a different situation from the US from that perspective. You can feel probably more stability in the US at this stage. We are still in a moving target in Europe with, again, more impact, potential impact of Basel IV on a model which is still very banking finance intensive versus capital markets, plus the construction of a banking union, plus rates which create in themselves, which is a game changer. If we stay for a long time with low rates or negative rates, it will be a game changer for not just the banking industry, but for the saving industry. So we are probably in a more complex situation. And I would say the key question for me, to a certain extent, is we've not tested the new system in a downturn. It's probably fair to say the system has worked so far, and including in Europe, where credit has been distributed pretty well, but in an overall relatively good environment. I'm a little bit more worried because we don't know exactly what the rules of the game are, actually, how the system could fare in terms of capital ratio, liquidity, from even a supervisory point of view. And again, we are going to accumulate the impacts of prudential, regulatory, accounting issues also, as I've said. The IFRS 9 in a downturn means probably more provisioning. What would be then the reaction of the banks in terms of capital allocation and capital distribution? And for me, it's a question mark. I don't have the answer.
Can I just add one thing on this? It's following up on your point. The whole notion of a counter-cyclical buffer that you would add in good times so that or when you thought there was excessive credit growth in the economy, that when times got tough, they would release the buffer. It sounds good in theory, but I am very skeptical that supervisors, safety and soundness supervisors, will agree to lower capital requirements as you go into a recession. It just goes against every fiber of how they look at the world. So I would be very careful about thinking that's a great tool, personally.
Okay.
But it happened already. I mean, the Bank of England lowered it.
But not in a situation where you really were worried about problems of solvency in your financial
Of course,
institutions.
after the Brexit vote.
Yeah.
Well, let's see.
So, all right.
I'm mindful of time, Doug, very briefly. Yep.
Yeah. So two parts to this. One, as you know, I've actually done major studies on the capital levels and the right trade-off, IMF and for GFMA. So I'm well aware that there is no scientific answer. There's a range of possibilities. Within that, I'm comfortable we're broadly at the right levels. My guess is U.S. is a little high, but that's more intuition. But the thing I particularly wanted to follow up on was Benjamin's great line about the plural of anecdote isn't evidence. Because while I'm very glad the FSB and the other bodies are doing this review, and they have quality people like Benjamin doing it, I do have a concern, which is it's pretty clear that from the FSB's point of view, when the global bodies made the original decisions, we all know it was based on preponderance of the evidence. There were lots of different questions and views, and you just made your best estimate. In order to avoid revisiting everything, however, the policymakers seem to have decided they will only make a change if you can conclusively prove things with statistics, then that there's no other explanation possible for the result you're seeing. And I think that's overshooting in the other direction. In the US, you can actually convict somebody of murder on circumstantial evidence. You just need a lot. And so I do think there are situations where sufficient anecdotal evidence should make the policymakers review some of their choices.
Okay, thank you. Felix, I think you said you wanted to circle back to a couple of areas in terms of outlook. Or do you want to?
I'd rather
would you like
skip that piece and come back to your question, which you just posed, which of course is the question: have we got the balance right?
Yep.
And I think let me just point to a couple of areas why I, being a regulator, believe we should address. I think one is, as I said, we should be more explicit on proportionality. Secondly, I think I would not retreat broadly based on capital and liquidity requirements. I think that's broadly the right thing. And you may be surprised, John, but I fundamentally share your skepticism about, let me put it, a mechanistic approach on macroprudential tools. I'm curious to see how it works. I do share, because that's a lesson of the last financial crisis, there is a systemic level, there is a need for macroprudential, let me call it attention, but having a dashboard and sort of counterbalancing economic cycles in a perfect manner, I'm quite skeptical as well. But it does mean we should abandon the whole idea of macroprudential tools. I already said we should carefully review certain components of conduct regulation, which, as I said before, bear the tendency of overshooting. So, to cut a long story short, I think there are various elements which deserve a proper review. But basically, I think, as I said before, I would very heavily warn for turning the whole thing back. That would be extremely dangerous. I think it would not be in the best interest of the industry. One last comment on cyclicity.
I agree, by the way.
Okay, good. Thank you. So we are even. Cyclicity element, I think, which Frederick and John referred to, I think that's a very tricky thing. To the extent we had a paradigm shift in financial regulation for both banks and insurance, from risk insensitive to risk-based regulation or risk-sensitive regulation, I think that's been very important and very good. But I do share one notion of skepticism. We have very little evidence how the interplay of financial regulation, which is risk-sensitive, and accounting measures, the interplay of both would really play out in times of a heavy down cycle. That remains to be seen, and it worries me because I don't know. So there is an element of it, but we shouldn't discredit risk sensitivity with being per se pro-cyclical. I would never go that far. I think that's been a good paradigm shift. So it's as always a very delicate balancing act. So a certain degree of risk sensitivity, and in that sense, pro-cyclicality is a good thing, because the experience we made in former times was that we were structurally too late.
Okay. I'm mindful we're just about out of time, but one thing that's occurred to me as I've heard the discussion of growth implications, the changes in strategy, the winding back of businesses, withdrawal, and some of those issues that come through the study that we've talked about, the consequences and potential unintended consequences. It reminds me of something Bill Cohen, a debate I had with Bill earlier this year, just before he finished up, about, he said, just why don't the banks just implement? We've shown with FRTB we're willing to review down the track. And he said, in some years' time, we'll do the same. I said, Bill, banks are making investment decisions now. They're making business decisions now. They're basing it on what they expect to be implemented by the local regulators in years to come. By then, it's too late. You might have 12 participants in a very important area, and when you come to the review, there's 5 left. So you've lost competition, touching on some of the things you touched on, John. So any final comments that people would like to make in terms of the timeliness of engagement between the regulatory sector and the financial sector in terms of constantly adjusting those dials to achieve what we call in our report perpetually appropriate regulation? I'll throw it open to whoever wants to make a final comment on that.
I can just make maybe one comment for Europe. I think it's urgent to have clarity on the strategic project of the European Banking Union, see exactly where we want to go. It's urgent to have also the clarity on the final regulation and calibration. Basel IV, it's important. And I would say to have a proportionate implementation in Europe, taking into account the way Europe today finances and the fact that capital markets are not there, because there was an intellectual construction to say rebalance towards capital markets. The problem is one thing has moved forward, not the other. And so we need to be a little bit careful in how we will implement Basel IV, and then effectively have stability, because stability is needed, and see exactly how we fare in, again, a cycle which might be less favorable.
I would add one thing. Yes, I think it's good to get to a steady state. That's a good thing for planning purposes. However, there is one thing I did want to mention, why I think it's so important what the FSB is doing with its reviewing projects. I do worry about fragmentation of regulation and different standards being implemented in different places, causing real disruptions over time. I do think reviewing what companies and how they've implemented to try to move back towards some common standards is really important. And so that's that may mean some more change, but I think it would be worthwhile change.
I think of that global to local that we're going into now, the risk of that kind of fragmentation is going to be brought into very stark relief. So there's a lot of new challenges facing all of us. But John, Doug, Felix, Frederick, Benjamin, thank you very much. Please join me in thanking the panel.